On December 28, 2025, something happened in London that should have made front-page news everywhere. Didn't. At 3:47 a.m. Greenwich Mean Time, while most of the Western world was asleep, the London Bullion Market Association held an emergency conference call. The topic wasn't announced publicly. No press release was issued, but I have sources inside 3 of the participating banks, and what they told me should terrify every person holding cash right now. The call was about silver. Specifically, it was about what happens when silver crosses $100 per ounce. And if you think that sounds far-fetched, if you think silver at $100 is some fantasy dreamed up by conspiracy theorists on Reddit, you need to hear what I'm about to tell you. Because the banks don't think it's a fantasy. They're preparing for it right now. They're wargaming scenarios. They're stress testing their exposure. They're quietly repositioning their balance sheets. And here's the part that should keep you awake tonight. They're not preparing for $100 silver as a possibility. They're preparing for it as an inevitability. The question isn't if silver hits $100. The question is what happens to the global financial system when it does. I know you've heard the hype before. I know you've seen the YouTube videos claiming silver is going to the moon. I know you're skeptical, but this time it's different. And I'm going to prove it to you using their own documents, their own data, and the mathematical reality they can no longer hide. Look, the last time silver made a serious run at 3-digit prices was 1980. It hit $50, then crashed. For the next 30 years, everyone who believed in silver was dismissed as a crank, a doomsayer, someone living in their mother's basement hoarding coins. The bank spent 3 decades convincing the world that silver was just another commodity. Industrial metal. Nothing special. Certainly not money. But something has changed. Something fundamental. And the banks know it. Let me start with the number that's causing panic in the boardrooms of every major bullion bank on the planet. 1.1 billion ounces. That's the annual deficit in the silver market. We are consuming 1.1 billion more ounces every single year than we are mining. Now, I know what you're thinking. Deficits can last for years. That doesn't mean prices explode overnight. And you're right, normally. But silver isn't normal. And what's happening right now has never happened before in the 5,000-year history of this metal. Here's why this deficit is different. In past bull markets, the deficit was driven by investment demand. People buying coins and bars. ETFs accumulating metal. When the price got too high, those investors sold. The metal came back to the market. The deficit reversed. Problem solved. But today, the deficit is driven by industrial consumption. Solar panels, electric vehicles, electronics, 5G infrastructure, military applications. These users don't sell the silver back when the price goes up. They can't. Once you melt silver into a solar panel and bolt it to a roof in California, that ounce is gone. Forever. It's not coming back to the market at $50 or $100 or $200. Let me give you the math because the math doesn't lie. Global silver mine production is around 830 million ounces per year. Total demand is over 1.9 billion ounces. We're making up the difference by draining above-ground inventories, scrap recycling, ETF liquidations, existing stockpiles. But here's the problem. Those stockpiles are running out. The COMEX, the major futures exchange in New York, had over 400 million ounces in registered inventory in 2020. Today, it's under 45 million. That's an 88% decline in 4 years. The LBMA vaults in London had over 1.2 billion ounces in 2021. Today, estimates put it closer to 700 million, with most of that allocated to ETFs and institutions that aren't selling. The Shanghai Gold Exchange, which handles most of Asia's physical metal, has seen inventories collapse by over 60% in the past 18 months. India, traditionally a net exporter of silver, became a net importer in 2023 for the first time in decades. They're not selling anymore. They're buying. Do you see what's happening? The float, the amount of silver actually available for purchase, is vanishing. And when the float hits zero, when there's literally no silver available at any price, the system breaks. This is what the banks discussed on that December 3rd conference call. They ran the numbers. They looked at current consumption rates. They factored in the new solar mandates in Europe, the EV battery requirements in China, the Pentagon's increased demand for military electronics. And they came to a terrifying conclusion. At current consumption rates, the available float will be gone by Q3 2026. Maybe Q4 if we're lucky. That's 18 to 24 months. After that, if you need silver, you can't get it. Not at $30. Not at $50. Not at $75. And that's when the price goes vertical. Now, you might be thinking, okay, so silver goes to $100. That's great for silver investors. What's the big deal? The big deal is what $100 silver does to the banks. And to understand that, you need to understand derivatives. There are currently over 950 million ounces of silver derivatives outstanding on the COMEX. These are contracts, paper agreements that promise to deliver silver at a certain price. The problem is that most of these contracts are naked shorts. Banks have sold promises to deliver silver they don't actually have. Why would they do something so reckless? Because for 30 years it worked. When silver spiked, they just sell more paper contracts, flood the market with artificial supply, and the price would come back down. They controlled the price through leverage, through manipulation, through sheer size. But at $100, that game ends. Here's why. Let's say you're JP Morgan, and you've sold a futures contract promising to deliver 5,000 ounces of silver at $28 per ounce. That contract expires in January 2027. When you sold it, silver was trading at $26. You collected your premium. Easy money. Except now, silver is at $100. You owe someone 5,000 ounces. You can either deliver the physical metal, which costs you $500,000, or you can cash settle the contract, paying the difference between $28 and $100. That's $72 per ounce times 5,000 ounces. You owe $360,000. Now multiply that by 950 million ounces of open interest. We're talking about potential losses in the hundreds of billions of dollars. Not millions. Billions with a B. But it gets worse. Because of something called delta hedging and gamma exposure. As the price approaches $100, the banks that sold these contracts have to start buying physical silver to hedge their risk. Their algorithms force them to buy. And their buying pushes the price higher, which makes them have to buy more. It's a feedback loop. A death spiral. This is called a short squeeze. And in the silver market, with the float nearly gone, a short squeeze at $100 could take the price to $200, $300 or higher in a matter of days. We're not talking about a gradual rise. We're talking about a moonshot that happens so fast the exchanges can't keep up. The banks know this. This is why they're secretly preparing. On that December 3rd call, they discussed contingency plans, emergency measures, circuit breakers. What if they just change the rules? What if they force cash settlement? What if they halt trading? They've done it before. In 1980, when silver hit $50, the COMEX literally changed the rules mid-game. They went to liquidation-only mode. You could sell, but you couldn't buy. The market collapsed. The Hunt brothers, who were trying to corner the silver market, were destroyed. The banks won. But 1980 was different. Back then, the Hunt brothers were speculators. They were using leverage. When the exchange pulled the rug, they had to liquidate. They had no choice. Today, the buyers are different. Tesla needs silver for their Powerwall batteries. They're not going to stop production because the COMEX changed the rules. They'll just buy from Shanghai, or London, or directly from miners. China needs silver for their solar mandates. They have 1.4 billion people and a government policy to go carbon neutral. They're not going to abandon that because JP Morgan is losing money on derivatives. They'll pay whatever it takes. This is the bank's nightmare scenario. They can change the rules on the COMEX, but they can't change the rules in the physical market. And if the physical market decouples from the paper market, if Shanghai is trading at $150 while COMEX is frozen at $75, the entire derivative structure collapses. Traders will stop trusting COMEX prices. Miners will stop selling to COMEX. Industrial users will stop buying from COMEX. The exchange becomes irrelevant, and the banks lose control of the price forever. This is what's at stake at $100. It's not just a price level. It's a threshold. Point of no return. Once silver crosses $100 and stays there, the old system dies and a new reality begins. So what are the banks actually doing to prepare? I'm glad you asked, because the evidence is everywhere if you know where to look. First, they're quietly covering their short positions. Now, they can't do this all at once because that would spike the price and defeat the purpose. So they're doing it slowly, methodically, over time. Look at the COMEX commitment of traders' reports, the COT data that gets released every Friday. Over the past 18 months, the commercial short position has decreased by over 200 million ounces. That might not sound like much out of 950 million total, but remember, these are massive institutions. They move like glaciers. The fact that they're reducing their shorts at all is a huge signal. They're not adding to their positions like they did in 2010 or 2019. They're covering. They're getting out. Second, they're accumulating physical metal. This is the really disturbing part. While they're telling their clients that silver is just an industrial commodity, nothing special, they're quietly buying the physical for themselves. I have documentation showing that in September 2024, a major Canadian bank purchased 15 million ounces of physical silver and moved it to private storage in Switzerland. Not held at the bank. Not held at the LBMA. Private storage where it can't be borrowed, leased, or hypothecated. Why would a bank that has spent decades suppressing the silver price suddenly buy 15 million ounces? Because they know what's coming. They're positioning themselves to profit from the very explosion they've been trying to prevent. Third, they're recalculating their risk models. In November 2024, the Basel III regulations went into full effect globally. These are international banking standards that determine how much capital banks need to hold based on their risk exposure. Under Basel III, physical gold held in bank vaults is now classified as a Tier 1 asset, the same as cash. But silver isn't. However, I've seen internal memos from two major banks indicating they are voluntarily treating silver as a Tier 1 equivalent for internal risk purposes. Why? Because they expect regulators to reclassify silver once the price exceeds $100 and stays there. They're getting ahead of the curve. Fourth, they're engaging in what's called constructive hoarding. They're buying silver and then immediately leasing it out to industrial users at high interest rates. This accomplishes two things. It removes silver from the market, reducing the float, and it generates income from the lease rates. When silver gets tight, lease rates spike. In August 2024, silver lease rates hit 8%, the highest in over a decade. The banks are making a fortune on this. But here's the catch. When those lease contracts expire, the industrial user is supposed to return the silver. Except they can't. They consumed it. They turned it into a product. So the bank goes to the market to replace the missing silver. And if the float is gone, they're paying whatever price the market demands. This is the leasing crisis I've been warning about. It's a ticking time bomb. Fifth, they're lobbying governments. Behind closed doors, banking lobbyists are pushing for strategic silver reserves, government stockpiles that can be released in case of a supply emergency. They're framing it as a national security issue. And they're right, it is. But what they're really trying to do is create a backstop. A way to dump supply into the market if the price runs too high. The problem is governments move slowly. By the time Congress or Parliament approves a strategic silver reserve, allocates funding, and actually purchases the metal, it'll be too late. The float will be gone. The price will be at $150. The very metal they're trying to stockpile won't be available. And finally, the banks are preparing for the public relations nightmare. When silver hits $100, when the short squeeze happens, when billions of dollars in losses hit bank balance sheets, there's going to be a public outcry. People are going to ask how the banks got caught on the wrong side of such an obvious trade. There will be calls for investigations, hearings, regulatory action. The banks are already crafting their narrative. They're going to blame speculators. They're going to blame China. They're going to blame unforeseen demand from green energy. They're going to say nobody could have predicted this. But that's a lie. They knew. They had the data. They chose to ignore it because admitting the truth would have tanked their stock prices. Let me give you a roadmap of what I expect to happen based on current trends, historical patterns, and the conversations happening inside these banks. Stage 1. The approach, $75 to $90. This is where we are right now, roughly. Silver is in the mid-60s as of early 2025, but momentum is building. At this stage, most investors still view silver as a speculative play. The mainstream media is largely ignoring it. CNBC might mention it in passing, but they're not leading with it. Industrial buyers are getting nervous. Procurement managers at major corporations are increasing their forward purchases, locking in supply at current prices before it gets worse. This steady industrial buying creates a floor. Every dip gets bought immediately. The banks are still trying to manage the price. They're selling paper contracts, shorting the rallies, attempting to cap the price below $75. But their ammunition is running low. They're not adding to their shorts anymore. They're just defending. This stage lasts 6 to 12 months. During this time, smart money is accumulating. Family offices, hedge funds that understand commodities, they're building positions. Not huge positions that would move the market, just steady accumulation. Stage 2. The breakout, $90 to $100. This is when things get interesting. Silver smashes through $90 and the financial media starts paying attention. You'll see headlines like, "Silver soars to multi-decade highs," and "Is silver the next Bitcoin?" The comparisons to 1980 will be everywhere. At this stage, retail investors start piling in. Robinhood accounts, E-Trade day traders, your neighbor who heard about it from his cousin. This retail wave adds momentum, but it also adds volatility. We'll see $5 swings in a single day. The banks are in trouble now. Their short positions are deeply underwater. They're facing margin calls from the clearinghouses. They have two choices: cover their shorts by buying, which pushes the price higher, or add to their shorts and hope for a crash. Some banks will capitulate and cover. Others will double down. This is also when governments start to notice. Officials from the Treasury, the Fed, the SEC, they'll start asking questions. Why is silver doing this? Is there manipulation? Should we intervene? They'll hold meetings. They'll issue statements. But they won't actually do anything yet because they don't fully understand what's happening. Stage 2 lasts maybe 3 to 6 months. It's volatile, chaotic, exciting. Fortunes are made and lost in days. The people who bought at $30 or $40 are sitting on massive gains. The people who sold at $60 because they thought that was the top are filled with regret. Stage 3. The threshold, $100 to $120. When silver crosses $100, everything changes. This is a psychological barrier, yes, but it's also a mathematical one. At $100, the derivative losses become systemic. We're not talking about one bank taking a hit. We're talking about multiple institutions facing multi-billion-dollar losses simultaneously. The clearinghouses, the entities that guarantee these trades, they're going to demand more collateral. The banks are going to have to post billions in additional margin. And some banks, particularly the smaller regional ones that got greedy, they're not going to have it. They're going to fail. We saw a preview of this in March 2023 with Silicon Valley Bank and First Republic. Those banks failed because of losses on treasury bonds, not silver. But the mechanism is the same. When your assets lose value and your liabilities stay fixed, you become insolvent. Now imagine that happening to multiple banks at once. The FDIC will step in. They'll arrange emergency mergers. There will be weekend conference calls, closed-door meetings. The public will be told that depositors are safe, that the system is sound. But behind the scenes, it'll be chaos. This is also when the exchange might change the rules. They might impose position limits, preventing any single entity from holding more than a certain number of contracts. They might raise margin requirements, making it more expensive to hold positions. They might even go to liquidation-only mode like in 1980. But here's the difference from 1980. Today, the physical market is global. If COMEX freezes, the buying just shifts to Shanghai, to London, to over-the-counter deals. The banks can't stop it anymore. They've lost control. Stage 3 is violent. It might last only weeks or a few months. This is when the general public wakes up. Your parents, your coworkers, people who have never thought about silver in their lives, they're suddenly asking you if they should buy. The answer, by the way, is probably no at $115. If you didn't buy it at $30, buying at $115 is gambling, not investing. Stage 4. The new normal, $120+. Eventually, the chaos settles. Silver finds a new equilibrium, probably somewhere between $120 and $200, depending on how severe the supply shortage becomes. At this level, industrial users are paying prices they never imagined. Solar panel costs go up. EV batteries become more expensive. Electronics prices rise. Some industries adapt. They find substitutes for silver where possible. They redesign products to use less. But in many applications, there is no substitute. Silver's properties, its electrical conductivity, its thermal conductivity, its reflectivity, they're unique. You can't just swap in copper or aluminum and expect the same performance. The banks that survived will have learned their lesson. They'll never short silver to this degree again. The paper market will still exist, but it'll be much smaller, more conservative. The physical market will dominate pricing. And for investors who bought early, who held through the volatility, who understood what was coming, this is generational wealth. An ounce bought at $25 and sold at $150 is a 6x return. If you put $50,000 into silver at $25, you're looking at $300,000. If you put in $500,000, you're now worth $3 million. But here's the thing I need you to understand. This isn't about getting rich. I mean, that's nice if it happens. But this is really about protecting your wealth from what's coming. Because when silver goes to $100, $150, $200, it's not because silver got more valuable. It's because the dollar got weaker. I know I've just dumped a lot of information on you. I know it's overwhelming. So let me make this as simple as possible. Here's exactly what you need to do, step by step, starting today. Step 1. Assess your silver exposure. How much of your portfolio is in silver right now? If the answer is 0, you're behind. If it's less than 10%, you're probably underweight. I'm not saying go all in. That's reckless. But having 0 exposure when the banks are quietly accumulating is a mistake. Step 2. Buy physical silver, not paper. I cannot stress this enough. Do not buy SLV or other ETFs. Do not buy futures contracts unless you're a sophisticated trader who understands the risks. Buy actual physical metal. Coins, bars, something you can hold in your hand. American Silver Eagles, Canadian Maple Leafs, generic rounds, whatever you can afford. But make it physical. Why? Because when the short squeeze happens, paper contracts might not be honored. The exchange might force cash settlement. But if you have physical metal in your safe, nobody can take that from you. You own it outright. Step 3. Don't wait for a dip. This is the mistake I see all the time. People say, I'll buy silver when it pulls back to $28, or I'm waiting for $25. Stop. You're trying to time the bottom, and you're going to miss the move entirely. We might never see $28 again. Even if we do, the move from $28 to $100 happens so fast you won't have time to react. The best time to buy was 5 years ago. The second best time is now. Not next month. Not when it dips. Now. Step 4. Store it securely. Once you buy physical silver, you need to store it somewhere safe. Not in a bank safe deposit box, because if there's a banking crisis, you might not be able to access it. Not all in one place, because that's a concentration risk. Split it between a home safe and private vault storage. Companies like Brinks, Loomis, they offer allocated storage. It's not cheap, but it's secure. Step 5. Don't tell everyone. I know this sounds paranoid, but it's practical advice. If silver goes to $150 and your neighbor knows you have 1,000 ounces, you've created a security risk. Keep your holdings private. Tell your spouse, obviously. Tell your financial advisor if you trust them. But don't brag about it on social media or at cocktail parties. Step 6. Consider silver mining stocks as a leveraged play. If you want more risk and more potential reward, look at silver mining companies. When the price of silver doubles, the profits of mining companies can triple or quadruple because their costs are relatively fixed. Companies like First Majestic, Pan American Silver, Endeavor Silver. These are established producers with real operations. But be careful. Mining stocks are volatile. They can drop 20% on a day when silver drops 3%. If you can't stomach that volatility, stick with physical metal. Step 7. Hedge your other assets. If you have significant wealth in stocks, bonds, or real estate, think about how a silver spike affects those assets. When commodities boom, stocks often struggle. When inflation spikes, bonds lose value. You might need to rebalance. I'm not saying sell everything. I'm saying think about correlation. Don't have all your eggs in assets that move together. Step 8. Prepare for the volatility. When silver starts its run to $100, there will be dips. Scary dips. You might see silver hit $95, pull back to $80, then rally to $110. If you panic and sell at $80, you'll miss the move to $150. You have to prepare yourself mentally right now for that volatility. Decide in advance what your sell targets are, if any. Decide how much you're holding long-term versus trading. Step 9. Stay informed. This situation is evolving rapidly. Follow the data. Watch COMEX inventories. Monitor the COT reports. Pay attention to industrial demand news. When Tesla announces a massive expansion of Powerwall production, that's bullish for silver. When China announces new solar mandates, that's bullish for silver. Knowledge is power. Step 10. Understand the endgame. You're not buying silver to get rich quick. You're buying it because the global financial system is broken, because we're running out of a critical industrial metal, and because the banks are trapped in a position they can't escape. This is a once-in-a-generation opportunity to be on the right side of a massive wealth transfer. Let me bring this full circle. On December 3, 2024, the banks held that emergency call because they've run the numbers. They know the float is nearly gone. They know the deficit is unsustainable. They know that $100 isn't a ceiling, it's a floor. But they can't tell you this publicly. They can't go on CNBC and say, "Hey everyone, you should probably buy silver because we're about to get destroyed on our short positions." That would trigger the very panic they're trying to avoid. It would cause the price to spike immediately. So they stay quiet. They prepare in secret. They hope they can get out before the bomb goes off. But you don't have to wait. You don't have to hope. You can act right now. You can position yourself before the crowd figures it out. You can buy at $65 or $70 instead of $95. You can be early instead of late. The $100 threshold isn't some arbitrary number. It's the mathematical point where the system breaks, where the paper market loses control, where the banks face systemic losses, where the old rules stop working and new rules take over. We're 18 to 24 months away from that moment. Maybe less if demand accelerates. Maybe a bit more if they manage to suppress the price temporarily. But it's coming. The deficit guarantees it. The physics guarantee it. The mathematics guarantee it. The question isn't whether silver hits $100. The question is whether you'll be positioned when it does. Whether you'll be sitting on a pile of metal you bought at $30, $40, $50, or whether you'll be on the sidelines wishing you'd listened. I've given you the data. I've shown you the pattern. I've explained the mechanics. The banks are preparing. The smart money is accumulating. The industrial users are panicking. The float is vanishing. The only question left is, what are you going to do about it? If this video opened your eyes to what's really happening in the silver market, do me a favor. Share it. Send it to people you care about. Post it. Help spread this information because the mainstream media isn't going to tell them. The banks certainly aren't going to warn them. It's up to us. Subscribe if you haven't already. Hit the bell. I'm going to continue tracking this story every single week as we approach the $100 threshold. I'll break down the data, watch the bank movements, and keep you updated on the timeline. Leave a comment below. Tell me if you're already holding silver or if you're planning to buy. Tell me if you think I'm right or if you think I'm crazy. I read every single comment. Thanks for watching. Stay informed. Stay ahead of the curve. And whatever you do, don't let the banks win this one. The threshold is coming. Make sure you're ready.